Hi everyone, it's Elizabeth with Engineering Economics video number 20, Income Statement Overview. So we will be learning two kinds of income statements. The first is a variable costing income statement, and that has, it's a variable costing income statement because after sales revenue, the first subtraction here, the first major category, the only category of expense or cost subtracted are variable costs. So let's start with the beginning. The first line of any income statement is sales revenue, which is selling price per unit times the number of units that were sold. That equals sales revenue. In this format of an income statement, we subtract out the variable costs to get to a subtotal called contribution margin. Now you want that contribution margin to be a large enough number in dollars to cover all of the fixed costs, which are subtracted next, and to still have money left over for net income. This format is also called a contribution margin income statement because of this major subtotal called contribution margin. This format is used for internal decision makers. It separates costs out by behavior. How do the costs change when volume changes? How do the variable costs change and how do the fixed costs change? It's forward focused. It's used for planning or projecting future costs based on changes in production levels, selling prices, etc., to see the effects on net income. This format is often called, it's used to do what if analysis. It's also known as cost, volume, profit analysis, which should be familiar from the break-even video. But here we're looking at what will be the effect on net income if variable costs change and if fixed costs change, if volume changes, number of units sold changes, if selling price per unit changes, what's going to be the effect on our net income. So that's used for internal planning and decision making beforehand. So it's a proactive planned financial statement. The traditional income statement that you'll more likely see actually, again, starts out with sales revenue. Same way, number of units sold times selling price per unit. But the major expense subtracted here first is cost of goods sold, which is an expense. This major expense is the cost of the items that were sold in that same time period. Remember, an income statement covers a certain amount of time, so we're matching the sales revenue with the cost or expense of producing those units that were sold that same time period. Cost of goods sold is made up of direct material cost, direct labor cost, and manufacturing overhead cost. Now these might be variable or fixed. They're all lumped together in cost of goods sold in a traditional income statement. The subtotal here is gross profit. And again, you want that to be high. Higher is better. And it has to cover all the other operating expenses and still have money left over for net income. The operating expenses here are not related to production, but instead they're related to administration, marketing and sales, probably research and development. Those kind of operating expenses are subtracted out from gross profit. This traditional income statement is for people outside the company. So that's why you'd be more likely to see this format. Investors, suppliers, lenders such as a bank, the Securities and Exchange Commission, and this is published on companies' websites for publicly traded companies, those with shareholders and stock. It separates cost out by either production or operations. Those are the two major cost categories in a traditional income statement. This format is required by the Securities and Exchange Commission for all publicly traded companies. It's historical. It shows the results of what did happen in the last time period. And again, it still uses the matching principle. Costs become expenses in the same period of time as the revenues that they produce. Now that is correct to follow generally accepted accounting principles, but from an engineering economics standpoint, it's not ideal because the actual timing of cash flows is ignored in this traditional income statement format. And in engineering economics decisions, we really do focus on cash flows. When are the actual cash flows coming in or going out? So over time, the aggregate recognition of sales, revenue, and expenses will equal cash inflows and cash outflows like we need for engineering economics. But the timing of those expenses will differ because companies, publicly traded companies, have to follow GAAP, generally accepted accounting principles. So that may give a little different timing result. The recognition of the expense may not be exactly when the cash is actually leaves the company. So again, for time value of money calculations, we must use actual cash flow estimates, right? It's not really actual, but it's cash flow estimates rather than GAAP timing. So we're not using the accrual-based income and expense recognition in our engineering economics calculations for net present value and internal rate of return and all the metrics that we've learned. The traditional income statement, here's another example with dollars here. And I wanted to point out another column that you'll often see, and that is a percentage column where sales revenue is set at 100%. And then all the other categories in the income statement here are shown as a percent of sales. So cost of goods sold is 450,000. That divided by sales is 45%. So every item will be shown as a percentage of sales. Even net income is a metric that you often see. Return on sales, right? So net income as a percentage of total sales revenue. And this is something that companies often track over time in their own company or between their company and their competitors in the industry. So this is called a common size financial statement. And this method is called vertical analysis when you're looking at the percentages there. Here's another just quick screenshot from Investopedia that basically says much of what I just spoke about. Common size income statements, like we just looked at, everything's in a percentage of sales, are useful to compare companies of different sizes. You can compare large and small companies and to spot trends more easily within your own company. When all the numbers are given as a percentage of sales, then you're not comparing like $100,000 of sales with $1 million of sales and their cost of goods sold. We're looking at everything as a percentage of that particular company's sales. Okay, that's it. Thank you.